We often hear about investment risk, right? And usually it's framed as markets going up or down, the fear of losing money when things tank.
Yeah, that's the standard narrative.
But what if the real risks, the ones that maybe quietly chip away at your gains, aren't the ones everyone talks about? Maybe they're things schools, well, they just don't teach.
Things hidden more in the structure.
Exactly, like how investing works or what you're actually buying. So in this deep dive, we're going to peel back those layers. We want to understand investment risk a bit differently, using insights from two real classics.
Which ones are we looking at?
We've got John Bogle's Common Sense on mutual funds, and then Graham and Dodd's Security Analysis. Giants in the field.
Absolutely foundational texts.
And our mission here is really to dig into what these experts see as the crucial, sometimes overlooked parts of risk you really need to grasp. Okay, so let's start with Bogle. Common Sense on Mutual Funds. He talks about risk, obviously, but maybe not just market volatility. What's he zeroing in on that might, surprise people?
Well, what's really interesting with Bogle is how much he focuses on risks baked into the structure of investing itself, especially with mutual funds.
The structure, how so?
He talks quite a bit about what he calls the tyranny of compounding costs. It sounds dramatic, but it's powerful.
Tyranny of compounding costs. Okay, that sounds less like market timing and more like, I don't know, a slow leak.
It really is. Think about high expense ratios. Paying, say, 1% a year versus maybe 0.2% for a simple index fund.
Yeah.
And then add trading costs. The friction when funds are constantly buying and selling stocks. Bogle estimated this could add up depending on turnover.
Right, the churn.
Exactly.
Yeah.
And he argues these aren't just tiny fees. They're a huge fiscal drag, that's his term. They quietly eat up a massive chunk of your potential growth over the long haul.
Wow, so you're saying a major risk isn't just the market falling, but actually the cost of being in the game, just grinding down your returns year after year.
Precisely. Bogle uses data to show this. He shows how these costs mean actively managed funds, well, as a group, tend to lag behind simple market indexes over time, consistently.
So the odds are stacked against you from the start, almost.
In terms of cost, yeah. He might show an index fund capturing, say, 97% of the market's growth, while the average managed fund gets maybe 70% because of those costs. Plus, high turnover can mean more taxes if it's in a taxable account. It's a risk that's always there.
That really changes how you think about chasing performance, doesn't it? Okay, let's shift gears then. Security analysis. Graham and Dodd, they come at risk from a totally different angle, right? More fundamental.
Yes, absolutely. Their question is more like, how do you make sure the thing you're buying isn't the source of the risk?
So avoiding buying something shaky or just paying too much.
Exactly. They focus on fundamental risk, the risk of overpaying or investing in a business that isn't sound. Their whole approach to safety is through analysis, trying to buy securities for, well, less than what they're really worth, building in a buffer.
Like finding bargains, essentially, ensuring value.
Precisely. They dig deep. For bonds, it wasn't just assets, but the company's earning power. Could it actually cover its interest payments?
Yeah.
That times interest earned ratio was key.
Makes sense.
And they warned about accounting tricks, how companies might, hide certain losses and inventory write-offs, retiring old equipment by charging them to old accounts instead of the current year's income. Makes the earnings look better than they are.
Sneaky. Hiding the real risk.
Yeah. And they were realistic, too. They knew that even the best analysis could face, huge risks during a really severe crisis, like the Great Depression they lived through, where even solid earning power just evaporated.
Okay, so we have Bogle warning us about these, like persistent structural costs, the drag on returns, and Graham and Dodd teaching us to analyze the actual investment, the fundamental risk, to avoid buying lemons or overpaying. How do they suggest we manage these different kinds of risk?
Well, Bogle's advice is really about simplicity and discipline. Keep costs low, so think index funds. Invest for the long term and use sensible asset allocation, maybe less stock as you get older, to manage the market volatility side.
Keep it simple, keep costs down.
Right. And Graham and Dodd, their management strategy is all about the homework. Deep due diligence, really understanding the financials, and critically demanding that margin of safety.
The buffer you mentioned.
Exactly. Paying significantly less than your estimate of the intrinsic value. It protects you if your analysis is a bit off, or just from plain bad luck.
This really highlights how understanding risk is so much more than just watching market news, doesn't it?
It really does.
You've got this quiet, almost invisible risk of costs that Bogle talks about, and then the fundamental risk of the asset itself that Graham and Dodd focus on. Maybe these are the risks that aren't emphasized enough.
I think that's fair to say. It suggests that real investment skill might be less about predicting the future and more about controlling what you can control.
Which
Controlling your costs, like Bogle says. And controlling the price you pay by doing your homework, like Graham and Dodd insist. Understanding what you own.
So what does this all mean for you listening? Perhaps the real secret, the one maybe not taught in basic finance classes, is simpler than we think.
Yeah.
Maybe it's about being relentless about costs, truly understanding the value of what you hold, and just sticking to a straightforward long-term plan. Something to chew on next time risk comes up in conversation.